الحمد لله رب العالمين صلاة والسلام على رسول الله محمد وعلى آله وصحبه أجمعين. Dear my ladies and gentlemen, today we are very happy to have you at SOCBA premises for very important subjects. Today we will have D.Rechard with us. He is a member of the International Sustainability Standard Board, and he will speak a little bit about the update of the board itself and the two drafts that they have made, which is related to the disclosures and also the facts and the opportunity and the risk that might be affected by sustainability standards, or also the effect of the climate on the financial statement or in companies. D.Rechard, he will be with us for maybe some time. He will visit some places and some ministries, and also if there is anybody who wants to speak to him, it's free. He can speak to anybody. Anybody wants to sit with him, it's up to him and up to you to either to take him also to your ministers or to your ministry and to discuss about the subject itself. We have arranged this workshop very quickly, and we prepared that to be in SOCBA premises instead of taking it to a hotel or places. So please welcome D.Rechard.
Well, thank you for the kind introduction, and thank you for inviting me. It's a real pleasure to be here. It's my first time in Saudi Arabia, and it's been an excellent experience so far. So thank you for being such kind hosts. So I'm just going to give you an overview of the work of the International Sustainability Standards Board, and we can do this in a very informal way. I mean, the lecture is very formal, but we can do this in a very informal way. It's very much a live project. You know, it's a relatively new organization. The world is changing very quickly in sustainability reporting, and we are at the heart of that change process. And so it's all really happening in real time, and I'm very happy to share any of that experience with you. So any questions that you have, anything that would be of interest, any sort of sense of how we're thinking and so on, very happy to share. I should probably say that the official decisions made by the board are made collectively by the board and not by individual members of the board. So these will be, in a sense, my views, but also my views of the views of others as well. So what I would also say is this region has been incredibly supportive of international financial reporting standards of IFRS, and obviously a key objective for the ISSB is to achieve the same sort of global reach that IASB standards already have. And so that makes it particularly pleasing to be here, actually, for that reason. So I've just got, this is a standard slide deck, and it's a standard slide deck which I'm not allowed to change, right? Because so some of these slides will be more or less useful. So I'll go through some of them more quickly, and I'll go through others more slowly. As I say, just please stop me with any questions. Very happy to answer as we go along. So this is broadly the structure of the slides. Okay, so whoops. So the foundation itself, the IFRS Foundation has now two boards that sit within it, as you probably know. It has a very strict, strong sense of due process, which is incredibly important. And so one of the things that feels unusual as a board member of the ISSB is coming into an organisation that in itself is new, but that is part of a very well-established infrastructure and due process structure. I think the importance of that will become more clear over time, actually. In a sense, it's quite difficult for us right now to follow due process and at the same time try to move very quickly. And so you can't do both things at once. But I think doing things in the right way is important, and we don't really have the option, right? We are part of this broader organisation. Okay, so the foundation maintains standards that are in the public interest. Now, in the public interest means focused on capital markets, and efficient capital markets are in the public interest. So one of the things that I think confuses people about the ISSB is the perception that because we're sustainability, we must be broadly about public policy or broadly about sustainable development goals or something. We're not. We're about investor-oriented disclosure because investors need to understand sustainability. So it's public interest in that sense. The high quality is understandable, enforceable, globally acceptable. These are core principles of IFRS. So, we have this wonderful platform to build upon. I think this just describes our process, and I think probably most people in the room are familiar with the IFRS process broadly anyway, so I won't dwell upon that slide. Okay, why the ISSB, and what does the ISSB exist for? Well, a few years ago, there was no chance that the ISSB or the IFRS Foundation would create the International Sustainability Standards Board. Before joining the board, I was an academic at Oxford, and many of you will know Bob Eccles, who's a sort of a familiar commentator in the sustainability reporting space. And he and I, between us, thought we would write a paper and organise a debate around the question of the Oxford Union on the question of should the ISSB set standards for sustainability reporting? And the reason we asked the question in that way was that nobody thought the answer was yes. Right? The IASB and the FASB both thought this is not what we do. We're not interested. Why would we do sustainability reporting? We do accounting. Meanwhile, the Sustainability Accounting Standards Board, the Global Reporting Initiative, the Integrated Reporting Council, the CDSB, you name it, all the other organisations operating in the space, they all thought, well, we do sustainability reporting. So both sides of the debate, as it were, disagreed with the motion. So it's actually remarkable this has happened so quickly. We are a sister board to the ISSB. Organisationally, within the structure of the foundation, we are equal. We sit alongside one another, same size of board and so on, same basic constitutional structure. This is really, really important. Global baseline. And let me just say a few things about how I see the global baseline and what that means. Because again, different people have different views of what the global baseline means. So, first thing, it's global, right? So one of the challenges that we have, and our chair, Emmanuel Faber, describes this very nicely. He says the challenge that we have is different from the challenge that the IASB had when it was created. Its challenge was to harmonise. So all countries all over the world had their own accounting standards. And the job of the IASB was to try to make them all move onto the same standard. Our job is the opposite. Our job is to avoid divergence. Because no country in the world, in effect, has mandatory sustainability standards in a significant and well-developed way. The risk is that different parts of the world develop their own standards and we don't achieve a single global solution in that way. So us doing our job well now is incredibly important to aligning different jurisdictions around the world in order that we can have what is a natural outcome for a standard, which is one standard that applies globally, especially important in the sustainability space. So that's one issue, it's global. Second issue is the global baseline is unambiguously investor-focused. So we have the same materiality lens the ISB has, the same materiality lens as security market regulators. Our focus is on investment decisions made by equity investors and debt investors, all categories of investor. If anything, there might be a slightly different focus for us than for the ISB. I think debt capital is, relatively speaking, more important in sustainability than it is in financial reporting standards. But nevertheless, the focus is on capital markets and on investors. Another feature of the global baseline is that in any jurisdiction in the world, you should be being asked to prepare the same information in the same way to meet the global baseline. So it would be a shame, it would be unfortunate if a company had to report twice within the same jurisdiction, once according to the global baseline and once according to whatever the local rules are. So the global baseline in part means avoiding that situation. So the obvious example of this right now is Europe. So Europe has been developing standards broadly in the public interest, not just in the investor interest. Embedded in their standards are various requirements that are similar to but not quite the same as the global baseline. So the risk is that companies, European companies, and if you're a Saudi company, you've got an operation in Europe, or you own a business in Europe, and then Saudi companies as well, okay, will end up having to report two slightly different sets of information. Nobody wants that. And so we're working very closely with the European standards setter right now to try to avoid that as much as we can. So the global baseline means the same calculation in different places. It also means that investor-oriented sustainability disclosures are not obscured by other disclosures. So you could imagine a very large sustainability report produced by a company, but a subset of the information is what investors want to know, and the rest of the information is not directly relevant to what investors want to know, and it can be difficult to separate one from the other. So reporting in that way does not satisfy the global baseline. The global baseline means you must be able to separately identify the investor-oriented information. So, and one more thing, the global baseline also means integrated with financial reporting. So in principle, a really strong feature of the ISSB is that it's part of the same organization as the IASB. Over time, it will become, I think, increasingly obvious how closely related sustainability reporting and financial reporting are. And over time, you will see both boards working together much more closely. The mission of the IFRS Foundation concerns material information for investors as a whole, of which some is financial and some is sustainability, and the two come together. So I think global baseline means all of those things. And it's a kind of central theme for what we do. Okay. You're probably familiar with the structure of the IFRS Foundation. The two key bits I draw attention to, the trustees, one of whom, the chair of your stock exchange. The trustees have been incredibly important in creating the International Sustainability Standards Board in the first place. They're responsible for raising the funds and so on that make the organization function so that the technical bodies, the IASB and the ISSB, operate independently of sources of funding. So the trustees play a critical role in securing adoption of standards around the world. And of course, ISSB standards are not adopted anywhere yet because they haven't been written yet. So the trustees have been incredibly important in establishing the ISSB. Once it starts to write its own standards and does its own thing, as it were, the trustees become less significant in terms of the ongoing operation. You'll notice an obvious gap on this slide, which is there is no ISSB Interpretations Committee. I think there will be in due course. So the role of the Interpretations Committee, as you may know, as you probably know, is to provide guidance and interpretation on existing issued standards. In interim standards, in some sense, they amount to. So we will have that process, I suspect, in due course, but not yet. Not sure why that's a separate slide, but those are our new logos, just so, just so you can see those. Okay, I've probably described most of that already, I think. The digital element is going to be incredibly important. One of the ways of resolving the issue of obscuring information is through digital tagging. One of the challenges will be what to tag and what to not. So if you're a company, so if you take the European legislation, I mentioned Europe because they're really pushing very quickly in this space. European legislation has an emphasis on double materiality. So the standards that they are in the process of introducing into law will require companies to report their impact on society and the environment and their impact on investors' investment, right? So both financial materiality and impact materiality, all of it. Now, if you're a company reporting your sustainability performance, I think it's probably quite a difficult thing to do, actually, to say, these are the impacts, positive or negative, social impacts that we have that matter to investors, but that don't matter, that matter to stakeholders, but that don't matter to investors. And it'll be very interesting to see how market practice evolves in that respect. I think in general in this space, the evolution of market practice is something that none of us can predict. There's a great deal of uncertainty about what sustainability reporting will end up looking like. And to that end, a really important part, I think, of what the ISSB needs to do is listen very carefully, not move too quickly, and make sure it sets the direction of travel appropriately. So it needs to move with an appropriate degree of urgency because the issues are urgent. But pushing too far ahead on the presumption that somehow we know what the answer is would be the wrong thing to do when actually practice is evolving so rapidly and in such an unpredictable way. So a great deal has happened in the past year. So it was only at COP26 in Glasgow that the ISSB was announced in the first place. And we're just coming up to COP27. So you can see, in this period of time that the prototypes, as it were, the precursors, the prototypes for S1 and S2 were already issued at the time of COP26. There was a chair and a vice chair appointed very early. Very, very good decisions. So Emmanuel Faber, who was chief executive of Danone, very large French public company, and had been chief financial officer prior to that. So very experienced as a preparer, very experienced in dealing with investors, very experienced in running a global organization. He was appointed as chair, and then Sue Lloyd, who had been the vice chair of the IASB, moved across to become the vice chair of the ISSB. And so she brings incredible depth of understanding of how the IFRS Foundation works, and how to prepare board papers and how to communicate externally and all sorts of things. So the two of them together are incredibly effective partnership. We've since added a third vice chair, who's one of the 14 members at the end. The third vice chair has come to us from the World Bank, where he was vice president and treasurer. So very senior, global, multilateral kind of background, and will be very important in his role, particularly focusing on global adoption and global relationships. So the chair and the vice chair were authorized by the Constitution to issue exposure drafts before the board was created. This is very unusual in the context of the foundation. A really important reason for doing it was to demonstrate momentum. If we'd waited until the full board was in place, then the change that's already happening in Europe at the SEC with TCFD and elsewhere would risk us being left behind. So actually it was very important to get something out relatively quickly. And the Constitution allowed for that. There was then a consultation process following the IASB due process. The comment letters were all analysed. There were 1,400 comment letters, so a huge response. They were analysed over the summer by our staff, and the board have really only just started meaningfully discussing and making decisions about all the comments and feedback that's come in. So the board has only met twice so far, so 2 full board meetings in July and September. It's meeting again next week, the week after, in Montreal. That will be a big meeting, very important in terms of the timeline. Likewise, November and December. The expectation is that by the end of the year, we will have made the substantial decisions that need to be made. So there's some really important things that need to be determined in really quite a short period of time. Okay. those are the board members. So Emmanuel and Sue mentioned, and Jing Dong is the World Bank guy. Constitutionally, the board has to be drawn from different regions of the world, but each board member does not represent a given region of the world. Each board member is an independent expert. That's the way it's set up. A feature of the ISSB in relation to the IASB is its multi-location setup. The IASB is very London-based, right? You know, the foundation, the IFRS Foundation, the whole of the board are all based in London. This organisation from the start was set out to have a global footprint, which you might think is a bit odd for a sustainability organisation, but anyway, it would set up a global footprint. Not least because sustainability is global, and because inclusivity is global, and because the global baseline is incredibly important for us. So we didn't want to risk being seen to be just an extension of the ISB in some sense. The San Francisco office is a legacy office. So when the organisation was created, the Sustainability Accounting Standards Board, well, a few months into the organisation, the Sustainability Accounting Standards Board was merged into the ISSB, so it no longer exists. The same is true for the International Integrated Reporting Council. The same is true for the Climate Disclosure Standards Board. So these organisations ceased to exist and became part of the ISSB. But most of San Francisco was the Sustainability Accounting Standards Board office. And so there's quite a few legacy stuff still in San Francisco. So in a sense, that one's different from the others. Frankfurt and Montreal are both set up especially for this organisation. And in a sense, those are the joint global headquarters. London is also a legacy organisation. So integrated reporting and CDSB were both London-based. So there are some legacy staff in London. And of course, the rest of the foundation is all in London. But that's not really an ISSB place, actually. During my time on the board, even though I'm based in the UK, I have not been to the London office. That gives you some indication that it's not central. Tokyo was an existing small small but significant IASB office. So the real innovation here is Frankfurt and Montreal. It looks like a bigger global footprint than it really is in some sense. So a difference from the IFRS Foundation was this global footprint. Another difference is the acquisition of other organisations and the acquisition of their intellectual property. So SASB standards becoming part of the intellectual property of the IFRS Foundation, and all of those employees becoming employees of the IFRS Foundation. So the organisation has simultaneously gone through major merger and acquisition activity and gone from being a local operation to being a global operation in terms of offices and so on, and opened an entirely new line of business. Instead of doing financial reporting, it's now doing sustainability reporting. So this is a huge amount of change for a relatively small organisation, all taking place at the same time. Okay. Global support, as you can imagine, incredibly important. We're very proud of having G7 support. IOSCO is enormously supportive, and that's incredibly important for us because that is, they are the international regulator, the body that coordinates international regulators on financial markets, and that's the focus for our activity. I expect to see more statements of this type. This is a communique from African ministers. This statement is important in two ways. First, that it is a collective statement by a geographic region. Second, that geographic region is developing. It's incredibly important for sustainability reporting that we are not setting standards for developed economies. We are setting standards for the global economy because sustainability standards won't work otherwise. Okay, so there are two standards. Maybe the way to talk about the two standards is I'll just say a few general words about them, and then invite comments and questions. The basic structure, there's S1 and S2. In the same way that when the IASB was created back in 2001, it adopted all of the IASC standards as its own. So on day one, it had a complete set of accounting standards. even though it hadn't written any of them. Right? So we did something similar, not least with SASB standards, SASB sector standards. So they're not formally part of IFRS in the sense that they have not been through the due process that S1 and S2 are currently going through, but they're part of our body of literature, as it were. So if you want to do sustainability reporting from day one, we don't just have a climate standard, we have a standard that covers everything. And so the basic design principle of S1 is it covers all sustainability-related issues and all issues of policy, adjustment to estimates, and all the other things, materiality, all of the other things that need to be covered as a general rule book, a general guidebook, a general framework for sustainability reporting. Meanwhile, S2 is a deep dive into climate, because climate is widely recognized to be the primary issue. There was consultation and due process around should we make climate the primary issue, and there was very strong support for doing that. It also enabled us to build on the work of the TCFD and other bodies very explicitly. Okay, so S1, notice the language here, sustainability-related risks and opportunities, well actually, significant risks and opportunities to assess enterprise value. So some of the feedback that we've got and which we will respond to is that language is not as clear as it should be. So sustainability-related risks and opportunities, that's okay, because that's saying from the perspective of investors, to what extent do issues of sustainability create risks for your business, whether transition or physical risk, and to what extent do they create opportunities for your business? So explain those risks and opportunities. That language is fairly straightforward. The word significant is actually not terribly helpful. What it's trying to do is it's trying to say we are not requiring companies to report all sustainability issues. So this is not a standard, S1 and S2 is not a standard which says, here's a list of 150 items that relate to sustainability. Tell us how you're performing on all 150. It's emphatically not that. It's a standard which says, which has a materiality filter. It says, tell your investors what they need to know. So of the 150, it may be that 4 really matter, and another 6 are fairly important. I mean, I'm making the numbers up, but you get the idea. So focus on the things that investors need to know to understand. This is the reason for your significant risks and opportunities, not all your risks and opportunities. So you can see that's what the word is trying to do, but it's not a terribly helpful word because it sounds a bit like material, and it's not quite clear what it means. So we have the feedback to think more carefully about that word. Likewise, enterprise value. The reason enterprise value is used is that it reinforces a focus on investors. It's unambiguously about the present value of cash flows. Right? So it's trying to say this is our remit. Feedback on that word or that expression is mixed. Oh, by the way, it's also helpful because it's shorthand. It's a very simple, short way of saying something. But people want to know, how are you defining enterprise value? Can you be more precise? Are you asking for a number? Are you asking for us to report enterprise value? Are you tying it to the current stock price in some way? If we're a debt investor and not an equity investor, then it's not really enterprise value as such that we're concerned about. It's the repayment, it's the ability to repay debt that we're concerned about. It's not quite the same thing. Why is ISSB using enterprise value if the IASB is not, when you've got the same materiality lens? So it's actually created quite a few bits of confusion. And again, so it's helpful feedback for us to rethink the use of that terminology. Okay, so first bullet, other standards, e.g. climate, set out specific disclosures. So we have the mandate to do the climate standard. We do not yet have the mandate to do a standard in it on any other topic. And so there is or will be shortly, an agenda consultation exercise, which is the same as the IASB does. It's part of the IFRS due process, And that exercise will say, dear stakeholders, globally, what do you think we should do? What comes next? I don't know what the outcome of that will be, but that will start fairly shortly. The second bullet, built into S1, and again, this is a kind of transitional thing. Built into S1 is a reference to what were the Sustainability Accounting Standards Board standards, what was the CDSB framework, and so on, as a way of saying, here's an indication of the kinds of things that you should be looking at. So, if you want to know what sustainability is, go and look at this information, these frameworks and these previous standards, and that'll give you some sense of the kinds of things you should be talking about. So again, it's not saying you must report everything that's in each of those frameworks. It's saying, here's something to help you figure out what's financially material that you must report to your investors because it's financially material. Okay. I've probably mentioned most of this. Publishing at the same time is important. So what's in S1 is a requirement that sustainability reporting and financial reporting happen at the same time. Now, it's important to break that down into two different issues. One issue is it sensible to report both things at the same time? And the second issue is, are companies ready to be able to report both things at the same time? The answer to the first question is, well, if you want to have integrated reporting, if you want your sustainability reporting to be connected with your financial reporting, to tell a story about the performance of the business during the year and how the business is being run strategically and so on, what the transition plans of the business are and so on, it's difficult to do that if you've got different reporting periods for sustainability and for financial. But that doesn't mean that companies are able to have the infrastructure or the assurance infrastructure, all the other things that would be needed to be able to do comprehensive sustainability reporting at this stage. That process of transition between where we are now to a future where sustainability reporting will, without doubt, be much more comprehensive and sophisticated than it is now, that will take time. And your guess is as good as mine about how much time that will take, but clearly the world is not ready to do everything on day one. Okay. So the climate disclosure standard is, first thing to say, it's very explicitly built on the TCFD. So the Task Force for Climate-Related Financial Disclosure has been an extraordinarily successful enterprise. Given that it was just a voluntary framework, it's been very widely adopted. Investors like it. Several jurisdictions around the world have adopted it formally. The number of companies preparing according to TCFD has grown considerably. So it has a certain appeal. And so we have taken the structure of TCFD, in other words, governance, strategy, risk management, targets and metrics, as the structure of the climate standard. Notice the second line. Built into this is industry-based climate reporting requirements. So a difference between financial reporting and sustainability reporting is that if you're reporting financial statements, every company is going to report assets and liabilities and equity and profit and loss and so on. Everyone's got financial instruments. So the accounts all look really rather similar. But in sustainability reporting, different businesses have different sustainability issues in different locations. And so you shouldn't expect the same level of uniformity. And if the focus is on which are, to use the word significant, risks and opportunities for your sector, which are the financially material risks and opportunities for your sector, it's helpful to have some guide. And the SASB standards provide some guide. And they've been through their own extensive due process over a number of years to provide some guide to what those issues might be. That doesn't mean those are the issues that companies in those sectors must report. It means this is how far we've got in thinking about that. So in the climate case, because we are this is not S1, where the other standards are in general referred to, but this is a specific standard on climate. This is a step further down the road in sector-specific disclosure. There are all kinds of disclosure requirements in S2, separation of physical risk from transition risk. The reporting on opportunities, which is actually incredibly important. You know, if you think about sustainability in the really big picture, it's a positive net present value proposition, right? You know, we tend to think about cost of sustainability because it involves transition. But actually, the ability, the capacity of the global economy to generate wealth in a sustainable future is higher than its capacity to generate wealth in an unsustainable future. And many of the businesses that will comprise the sustainable future have not yet been created. And so actually it's a really important part of this standard that it acknowledges it's not all about risk, it's about opportunity. It's about explaining to your investors, how are you going to do well in this environment? If you're one of the big four, I know there's members of the big four in the room, opportunity is written all over this space, right? I mean, this is a huge growth opportunity for your business. And it's a sustainability-related growth opportunity. So just a few comments about features of S2. First one, transition planning. There are disclosure requirements in S2 which ask companies to explain what their targets are and how they're going to transition towards those targets. Notice there is no policy role for the ISSB. We're not saying these are what your targets should be. We're saying whatever your targets are, explain them to your investors so your investors understand them. Here's a difference with the European double materiality standards. In the European standards, there is a requirement for disclosure which is aligned with 1.5 degrees global warming, with the Paris Agreement as they have interpreted it. So our standard doesn't do that. If your business is not reducing climate carbon emissions in line with science-based targets towards 1.5, but instead is aiming for 2 or something else, then our requirement is to explain whatever it is that you're aiming towards, to explain the business. So in principle, this should be reporting that helps the management of the business communicate the sustainability, governance, and strategy and so on of the business to its investors. Climate resilience, there is a requirement for scenario analysis. Now, a broader term for that would be resilience analysis. There is a particular set of techniques associated with scenario analysis, which is narrower than the broader set of resilience analysis. Different businesses are at very different stages of being able, or having a history of, or being able to do scenario analysis. And we recognize that. So this raises, again, a really big, really important question around transition, proportionality and scalability. I think I'm going to come back to that, so I'll just mention it now and come back. Scope 1 to 3 emissions, the requirement is to disclose Scope 1, 2, and 3, not least because in many businesses, Scope 3 is the largest part of the footprint of the business, and investors need to understand Scope 3 in order to understand the transition that the business is going through towards a more sustainable future. Again, Scope 3 raises all kinds of practical measurement issues that are novel, that are very much in their early stages, and that again raise this issue of proportionality and scalability. So again, there's a need to make a distinction between what would be desirable and what is currently practical. And to the extent that something is not currently practicable, there has to be some way of phasing in the requirements, which we have not yet worked out. This will be a discussion in the forthcoming board meetings, and won't be easy, I think. Okay, so I've described this. This is just quite a nice graphic that illustrates how the two sets of standards, in principle, are designed to work together into a single integrated disclosure for the benefit of investors. we've reached an agreement with GRI. GRI has a perspective very similar to that of the double materiality perspective in Europe. GRI is very widely used internationally, as you know. It was the first starter in this space. It's been going 25 years or something like that. It has a very comprehensive set of metrics. But it's trying to do something that's not what we're trying to do. So whereas SASB and TCFD and integrated reporting are all investor focused, GRI is not. And so there is a role for collaboration between ISSB and GRI rather than for integration between the two, because they are trying to do something different. So that's the reason for that agreement. Okay, I've already mentioned some of the feedback, so I might pick up on some other points here, but I may have mentioned them all already. We had more than 1,400 responses to the consultation, which is very high. And so it indicates the level of interest in this topic. There were also lots of outreach events. I think we reached 30,000 individual consultations in total during the whole period. And so we got a lot of input from a wide range of stakeholders across a wide range of geographies, and a lot of work for the staff in trying to code all of that information and consolidate it into board papers for the last meeting. You can see that for yourself, the geographic and the stakeholder spread for S1, and then as S1 and his, actually, I'll come back to S2. So overall, strong support, actually, which is very encouraging. So that generally, if I were to summarize the comment letters at a very, very high level, it would be, we support what you're doing, we're anxious about various aspects of what this means and what it's going to look like. And we can't picture it clearly enough, and there are various things that concern us. So I'd say that's broadly the overall statement. So there's basic support for the structure of S1. I've mentioned the need for greater clarity. There's also a demand for guidance and examples. Again, not surprising. We would like illustrative examples. So when you ask for information on financial effects of sustainability-related risk and disclosure, what does that, risk and opportunity, what does that actually mean? What does it look like? You know, what is a disclosure about financial effects? So the good news is we will have some time in between finalizing the standard and it being published to develop materials of this kind. Now, how we will do that, in conjunction with whom we will do that, remains to be decided, but there's clearly a demand for more guidance. And by the way, I should say, in some of this, there's probably a presumption that that we have a more of an idea of what disclosure should look like than we actually do, right? Because this is an emerging field. The market is going to change dramatically over the course of the next few years. Nobody is able to predict what sustainability reporting will look like. So our role actually is to set the direction of travel, things like the global baseline, you know, aligning different jurisdictions, setting out a reasonable set of requirements and sensible transition criteria, and then allowing practice to evolve, and then doing more to support the development of that practice. There isn't some kind of clear, you know, in 10 years from now, a sustainability report should look like this. That would be a naive starting point, I think. The connected standard setting, so the word connected or the word integrated both are used to mean the same thing, which is connection with the financial statement. So general support for that. S2, similar distribution, similar response level. Again, response proposals on the whole well received. I mean, that's not surprising because the proposals are very closely modelled on the TCFD, which has been well received. There is so much climate reporting practice already done. The greenhouse gas protocol is very widely used and widely understood, and so on. So, I think, and you know, the issue of climate is very widely globally understood, and the Paris agreements and all the rest of it. So, it's not actually that surprising that there's general support. And also, obviously, the need for urgency. I think that goes without saying. Again, the request for more guidance and examples. And here's the issue again: proportional. So, this is really critical. And this is not just an issue that applies to smaller organizations or organizations in developing countries. This applies to all organizations. So if you are a major multinational corporation in a developed economy and you've got operations globally, you're going to have challenges getting Scope 3 data for all of your operations because your supply chain is not the same size as you, right? So actually the issue of proportionality, scalability, ability to access information, ability to have the disclosures that are required is a challenge for all entities at some level. And obviously, especially, it's a Scope 3 challenge. Scope 1 and Scope 2 with indirect control are much more straightforward. So we need to figure some sensible language, some sensible provision that enables learning and transition, experimentation, actually, as well. And we can do that in conjunction with the market. So if you've got several companies in the same sector of the economy, and they're all trying to figure out what sustainability reporting looks like, multiple investors all investing in that sector, the dialogue between investors and companies, and companies observing one another, will develop a consensus, a social norm about what sustainability reporting looks like in that sector. So I think those things will just naturally evolve. And of course, the expectations on entities to provide data upstream to the reporting entity, or indeed downstream, will also just increase naturally over time. Okay, just a few more slides, I think, and this is more a broader governance structure around the organisation. And some of these, so there are various organisations that we are setting up, and some of these are temporary, some of them are being set up. But the idea is that these bodies are there to advise and to guide and to steer our operation. So the jurisdictional working group, you can see on the bottom right there, is comprised of a few jurisdictions, Europe, the US, and so on, China. Actually, Europe, I'm actually not sure, there's 5 or 6 of them. A few jurisdictions where, if we can work effectively, take the Europe example, if we can work effectively with Europe in developing a global baseline, so we can have a bilateral relationship with Europe that works in the context of bilateral relationships that work with the others, then we can be fairly confident we've got a global baseline that will apply globally. So the jurisdictional working group is a sort of informal group which is helping us to navigate that adoption, that jurisdiction issue. A more formal process will be the Sustainability Standards Advisory Forum, which will have standard setters from around the world. So that maps onto a comparable body for the International Accounting Standards Board that guides their process. Likewise, the Investor Advisory Group. The Sustainability Consultative Committee is dominated by a multilateral presence. So this is where you find OECD, United Nations, and so on. Again, to give us just that global perspective, and also to help us anticipate sustainability issues that will become financially material. Okay, so we're going to finish our discussions on S1 and S2 by the end of the year. That's the plan, all going well. People are working very hard on this. Final standards will come out early next year. They will be finished, I should say. They then need to go through a process of translation, right? And I've just seen the Saudi version of IFRS, and you can see how much work goes into the translation, right? And then, I've talked about the gender consultation and likewise digital taxonomy consultation. Those come further down the road. This is just a summary of what was discussed at the September meeting. Very high level, actually. So no particularly significant decisions made. We absorbed all of the consultation feedback that the staff prepared for us, and we made some broad decisions that encourage the direction that the staff is going in. The key decisions will start to be made next week, actually, in Montreal. There you go. And these meetings are public, right? So if you want to sign up to the webcast and watch them being broadcast live and so on, then please do. That's what that process is for. So we are not allowed as a board to meet other than in public on technical issues, to make, well, we can have dinner, right? But we can't make technical decisions except in public, right? So that's part of the constitutional structure. That's just our final process. Notice there's no committed date. And that's it. Advertisement for listening into meetings, following us online. And let me stop there and welcome any questions that anybody has. Far away. I'm not sure if there's a microphone in the room or whether you don't need one or... Sure, yeah, I can hear you, but if others can hear you, yeah. Actually, before I ask the question, can I just say how grateful I am to be able to speak in English and how much I appreciate that that's okay, that you have that ability. So, go ahead.
First of all, thank you for this informative workshop. This is a very important topic. I'm Dr. Wafa Nasrallah. I'm very interested in this topic because I've done some research on using sustainability reports in Saudi Arabia.
Yeah.
So I've seen Saudi organizations use the GRI for the last, I've done work since 2005.
Mm-hmm.
So I've seen a lot, one of them, the big giants is Aramco. So I've read your standards, and I know that you mentioned briefly that you guys, in a way, are not really merging with the GRI reports. Yeah. It's a robust structure. Yes, it is different. It measures materiality differently, but it is 25 years in the making. Why not lean more? Thank you.
So it's a good question. In fact, one thing I didn't mention that I should have mentioned, the difference in materiality is an easy one to make conceptually, a very difficult one to make practically, and actually in many ways unhelpful practically. If you look at climate in particular, there are very few disclosures that would have impact materiality, but not financial materiality. Because climate is such a well understood, such a prevalent, such a socially important issue that it's hard, and because companies have either their own commitments or legal commitments or government policy commitments, signing up to Paris or whatever it is, it's an unavoidable issue for most corporations. And so the distinction between single and double materiality really doesn't matter very much, actually. So if you look at the kinds of GRI metrics on impact, they're in S2, right? So you think, sort of greenhouse gas emissions, right? Emissions is an impact metric. So investors are not actually interested in emissions. They're interested in, if you're a business with high emissions, what does that mean for the value creation of the business? The interest is not the emissions themselves, right? It's not the impact itself. It's the economic consequence for the investment of being a business with high emissions. So that issue does vary across different topics, across GRI. And if you think about I described the protocol way back when, which protocol was developed into the exposure draft, which is now being deliberated. The team that worked on the protocol included GRI. So it was a joint project. And GRI and TCFD and CDSB all build on the greenhouse gas protocol. So in that particular context, actually there's considerable overlap. So I don't think there are tight boundaries between the topics that each standard setter, because they all look at each other's work, right? The difference is one of, and what difference I was trying to describe, which ignored all this, which I think is incredibly important. The difference I was trying to describe is what's the ultimate policy objective? And the policy objective of GRI is different from the policy objective of ISSB. That's all I was saying.
Shukran. Abdurrahman Al-Gwaiz, I'm with the Ministry of Energy. First of all, thank you, sir, for the presentation. It was very enlightening. I, for one, am all for standardization. It makes things much easier, and certainly any efforts to kind of improve sustainability and address climate change are worthy efforts. Of course, I note that your scope is international, and when it comes to these issues, sustainable development and climate change, there's significant disparities across regions and even companies, certainly between developed and developing countries.
Yes.
And sustainability is an issue that's, that maybe some stakeholders might be, it can only be understood in the local context.
That's right.
So I imagine that there might be a trade-off between standardizing sustainability reporting and climate change and ensuring that this reporting is relevant to all stakeholders according to their local circumstances.
You're absolutely right. Yep.
So I'm just wondering, how did you tackle that issues? What, let's say, measures have you taken? What provisions are in these standards? I see that you focused on climate change, and that's certainly, an important issue globally. But for example, would the other, let's say, SDGs like education, industrialization, poverty, hunger, would that all just come under S1? Is that, I don't understand.
So it's a really good question, and there's multiple parts to answering it. So this might be a bit of a ramble of an answer, but it's a very good question. So one of the things about climate, and one of the reasons why it's attractive as a subject to write a standard, ignoring the importance of it, is that a ton of CO2 in one place is the same as a ton of CO2 anywhere else, right? And they're relatively measurable, and we already have a system for measuring. So actually it's an easy standard to write. If you take a topic like water, then clearly a litre of water in one place doesn't have the same value, use, scarcity as it does in a different place. So you can't just add up in quite the same way. And most sustainability issues are like that. And so if you think about environmental metrics, they are local by nature. They may apply at a kind of ecosystem level, but nevertheless they're local issues. And so a real challenge, I don't know what we're going to do with this, to be honest, and I think it's a really difficult challenge, is how do you go from a series of locally managed issues to a summary report? You don't have that problem in financial accounting. In financial accounting, everything adds up, and it all ends up in the balance sheet, right? And it all ends up in a change in the balance sheet. So the local issue is a non-issue, but for sustainability reporting, it's a big issue. And then that's environmental. Social is the same again, but social is even more difficult, actually, because social norms vary in different parts of the world. And they don't, and they vary because values differ, right? And so we could all agree that not running out of fresh water is a good thing. That's just kind of an objective statement. We can all agree that more forest is better than less forest. But when it comes to social values and social norms and what any given society or culture values, who's anybody to decide? That's the matter of that's explicitly a local matter. So now it's important to say that our objective is not to implement the Sustainable Development Goals, thankfully, because that's a big job, right? So issues like education, health, diversity, inclusion, those issues matter from an ISSB point of view insofar as investors care about them. So, if you're running a business where equity and diversity and inclusion is for whatever reason important to your business, whether it affects your consumers' willingness to buy, whether it affects employees' willingness to work for you, whether it's adherence to the law in particular jurisdictions, whatever it happens to be, or whether you have some model of it enhances value creation by having more diversity or something, I don't know, right? if it's not relevant to investors, it's not part of our required disclosures. So that makes the problem easier. So final thing to say, there is a task force on nature-related financial disclosure that's about to put out its prototype report, I think. They've adopted the same structure of TCFD very deliberately, the same name basically. But the big defining difference, as I understand it, I haven't seen it yet, but the big defining difference is that they deal specifically with location, because that's the difference between environment and climate. So it'd be interesting to see what they say, actually. There are not easy answers to those questions, I don't think. Yeah.
Right. Good evening. My name is Luciano Iannelli. I'm an advisor to the Minister of Investment here in Riyadh. Thank you very much for this presentation. I was particularly appreciative of two things that you said, that the implementation will be as soon as possible in 2023, early 2023. That seemed to me a bit different than, seems to me that first I hear talking about January the 1st. I might be wrong there.
You are right. That was an expectation set at COP26 before anything had been put into place.
But I was also, I think it's probably connected to your considerations about proportionality and scalability, tools to support small companies. So I have questions around that, just to put them together. There will be a settling in period after the implementation, the timing that you expect until things become really mandatory. And then also, will these standards apply to all entities who adopt IFRS irrespective of size? Or do you anticipate ISSB to amend the IFRS SME standards to incorporate all or part of the disclosure requirements at the S1 and S2 level?
Okay, so on the proportionality thing, there are conceptually two quite different approaches. The European standard, as drafted, sets dates. So if you are a listed European company currently applying the non-financial reporting directive, you go first, right? And then a year later, I can't remember the exact categories, there's 4 categories. And so maybe it's all other large businesses or something, and then it's all businesses in Europe. So the European rules actually apply to all companies, partly the answer to your question. By size, yeah, all by size, yes. So, and then the final category is overseas businesses with operations in Europe. So those are dates, right? The other way to do it, and this was the discussion at the last board meeting, which is on the public record, the staff were proposing, and we encourage them to carry on thinking about, a model which is based upon a principle rather than a rule. And the principle would be, you should report unless you are unable to do so. Now, that then raises the question of what does it mean to be unable to do so, right? So, it's difficult to write principles like that. But you can see the logic of that. So, if you're, whatever, some Citibank or something, right? You're going to be further down the road than if you're some small financial services operation in I don't know, Ethiopia or something, for the sake of extreme examples, right? So, once you become able to, so it'd be hard for Citigroup to make the same "we are unable to do so" case as the Ethiopian operation. And it may be the case that the Ethiopian operation never achieves the level of disclosure that Citigroup can achieve because it's not the same scale of operation, right? So the value of a principle like that is that it can be applied universally. Now, having said that, a very important difference, and to repeat, the reason I'm focusing on Europe is because they are pushing through legislation right now, as we speak, right? So the big difference between us and Europe is that Europe has legislative authority. We have none, right? So for us, the issue is not what do we require companies to do so much as how does each different jurisdiction choose to use our standards? So for IFRS, it's listed entities, and that's the norm globally. So if you have listed securities, you use IFRS. Now, you'd expect something very similar with ISSB, but that's not a decision for us to make. So in the European context, listed entities, you would hope, will be reporting the same global baseline that will satisfy ISSB criteria, but many other companies in addition will be required to do sustainability reporting. Does that answer your question?
Ultimately, the relevant authorities in the case of the ISSB remain very important, the local jurisdictions to implement at the SME level.
Hugely important, yeah. Yes, yeah, the regulators, the regulators, the stock markets, the governments, because we are just a private standard setter. We have no authority in that respect.
All right, thank you very much.
Assalamu alaikum. Ahmed Agil, EY. Just a quick question. I think you've touched upon it in terms of compliance with the requirements of disclosures. I believe the main driver in the majority of the jurisdictions are coming from initiatives such as Fit for 55 or the Paris Agreement or UK commitment to green energy and renewable energy. So do you see other motives for companies to be able to implement such disclosures other than these kind of policies or the listed company CMAs or the capital?
I mean, I think that the simplest, most general response would be it's very similar to financial reporting. If you want investors to invest in your corporation, if you want banks to lend to your corporation, then what you don't want is an asymmetry of information between them and you. So, you know, the standard rationale behind financial reporting is it lowers the cost of capital, and the provision of standards is a public good. It's something which needs to be publicly funded in order that society as a whole can benefit from it. That's the way it works. But you know, the underlying economic rationale is it lowers the cost of capital. I think this is the same. And if you think about the scale of business transition associated with sustainability, investors need to understand that. I think one of the things that's distinct about sustainability, this is what relates to the commitments, is that by making commitments, whether it's Paris or any of these many others, that becomes a stated part of the transition plan, right? So it's, okay, well, you said you're going to do this, now tell us how you're going to do it, right? There's a famous example of this being done badly by the UK government this past week, right? Of the Chancellor of the Exchequer saying, we're going to cut top rate tax and we're going to, but I haven't done the numbers yet. I've no idea how it's going to work, right? And so the pound crashed and the interest rate went up and the Bank of England had to bail out the government because investors didn't understand what they were investing in. So it's actually basically the same principle.
Perhaps another second question related to the same point. As we see that jurisdictions are investing in VCMs or creating those platforms for investors who are producing carbon credits, I haven't seen, or maybe excuse my ignorance in terms of, is there any of the disclosure touching upon
carbon credits?
Oh, right.
Yes, absolutely. Yes. Okay. So the required disclosure is basically gross and net, right? So you know, what's your plan on gross emissions and what's your plan on offsets? How are you going to use them? So again, it's not our job to tell companies what to do. It's our job to set the standard that helps investors compare what companies are doing. And that standard in turn helps the companies to communicate what they're doing because they're communicating in the same way as other companies. So yeah, part of the communication is what is your offset strategy and how you're implementing it. Absolutely.
Good evening, Ted. This is Mohammed Asfar representing SABIC. Thank you very much for the session. I have actually two questions. Since we touch base on the global baseline, I understand that we have SAS-based standards. Then there are some developments coming from IFRAG. Now we have US GAAP also coming up with the sustainability standards. S1, S2 are already we have discussed. So what I'm trying to assess, and for an organization like SABIC, wherein there are operations in Europe, in KSA, in the US, how is this baseline going to be achieved if we have to report through IFRAG, or there might be S1 and S2 implications?
So I missed the end bit. How is the baseline?
Yeah, so is it going to be any unifications that's going to be achieved down the line? Because we have a different set of standards.
Well, the reason, so IFRS accounting standards are pretty much global outside the US. At the time that those standards were written or were introduced, the US was not only the world's largest capital market, it also had by far the world's most developed accounting standard setter. And in fact, international standards are largely based conceptually on, well, conceptually almost entirely based upon US GAAP. So the US already had a comprehensive set of accounting standards and also a jurisdictional structure whereby they are controlled by the SEC ultimately. And so no obvious incentive to change that actually. Sustainability reporting is different because there is no FASB for sustainability reporting. So there is no established practice. Moreover, the US is not moving quickly in this space. It's introducing a climate disclosure rule, as you probably know. So in effect, that's a bit like S2, but S2 without S1. And so there is a big gap in required sustainability reporting requirements in the US. Now, which is not the case with financial. So the question then becomes one of what will happen in the US. What I would hope will happen is that the largest US investors, which are huge globally, will want a global baseline, that a global baseline will evolve through the ISSB, and it will become a natural default for US corporations to voluntarily use the global baseline. Because why would they not? If General Motors wants global investors, then it makes sense for it to report in the same way as Toyota or Volkswagen on issues that are of shared interest. So I think a really interesting development yet to be determined will be how much the market itself brings about its standardization, how much that reinforces the process. It's not just a regulatory process, I think. And that's quite different from accounting.
Yeah. So just last question related to the assurance. I understand that there is a requirement of limited assurance for carbon credits. But as a standard, are there any guidelines for assurance? Are they going to be in terms of?
Well, here's an example of sustainability-related opportunity, right? Carbon credits is a relatively young market, and it's developing very quickly. And so the infrastructure around it, the professional services around it, the markets themselves will grow enormously. It would be very surprising if they didn't. And as they do, then you end up with data that is more verifiable, more directly comparable, and so on, that goes into the sustainability reporting. So we have nothing to say about that. That's not our role is just to say, well, tell us what you've got, and tell us how confidently you can reassure investors that you're offsetting your carbon. As the market evolves, the confidence level will grow.
Hello. First of all, I'd like to say thank you for coming to Saudi Arabia and speaking with us. I think it's a very pertinent discussion today, and I want to thank as well Sokpa for graciously hosting us all here. I realized in the presentation that there was a discussion about the spectrum of readiness in terms of whether companies will be able to
Yep.
to report on this. And that's, I think it's a very important nuance that's captured. And my question, and forgive me, I'm coming from the climate world more into the, so I don't have the clear picture of how this will be implemented. But I wanted to ask about the spectrum of readiness within the context of developed economies, advanced economies, and emerging economies. So obviously, there'll be, on average, more preparedness amongst companies operating in advanced and developed economies than developing economies. And when taking a look at something like ESG, for example, you see that only 10% of ESG-related investments are going to emerging economies. And that's because these standards were, the frameworks and scoring frameworks were set mostly in the context of developed economies and so on. And I wanted to ask, how is this being taken into consideration in the development of these standards?
That's a really good question. So, in principle, what we are doing is entirely neutral, right? In principle, all we're doing is saying, describe what is. We're not seeking to influence, we're not seeking to introduce policy or persuade management to do one thing rather than another. But any form of standard setting regulatory intervention creates what you might call unintended consequences, right? And in this context, clearly if picture a business in a large business in a developed economy that has multiple sources of supply, and that business is being called upon to produce reliable Scope 3 emissions data, and some of its sources of supply are better responding to, small businesses, or medium-sized, let's say, or different geography, different countries. Some places are better at providing that information than others. They then end up with a competitive advantage that they didn't previously have. I think that's very real. At the same time, I'm not sure what we could do about it. You can't really, I don't think, anticipate the multiple complexities of that. But what it does do is create incentives. That's right. So if you're a medium-sized business exporting to, you're based in Argentina, you're exporting to Europe. It's really in your interest right now to make sure you can communicate your Scope 1 emissions to your upstream.
Scope 3, you mean?
You'll be in a better place than your Brazilian competitor.
Yeah, I understand that. I think this is where, for example, it might be disadvantaging certain regions and areas and companies in these areas. And so that brings me to another point that I thought about. If you take like a company A, for example, and company B, and they reduce the same ton of CO2 equivalent in one financial year, but company A exists in a country where 90% of the electrical grid, for example, is decarbonized. Country B exists in a country where 10% of the electrical grid is decarbonized. So, where is the space of providing adequate guidance to investors, users of these disclosures?
Well, so one reason why this is complicated is that there may well be a self-correcting mechanism in there, right? If you're a global food producer and you source from, in one economy, you source from small farms, and in another economy you source from some major broker or something, you're not going to want to explain to your investors why you abandoned all of your small farmers. That's not a good sustainability practice, right? So actually, those are the things that we've yet to see what might or might not happen. You see what I mean? And that in itself would be a hard story to tell, and the kind of thing that creates adverse media coverage and all the rest of it. So your guess is as good as mine. But,
Okay, thank you. I don't want to take too much time, but generally when it comes to risks and opportunity reporting, the time horizons are short, right? It's something like climate, the time horizon is quite long.
Well, actually, this time horizon is built into the standard, so the language is short, medium, and long term. If you think of short term as being a 1-year reporting cycle, so those are the kind of, you're thinking along the same time period against which you're thinking about budgeting and other such financial reporting. And then medium term and long term is going to vary with your business, actually. Some businesses have a very long operating cycle and others don't. But there is explicit requirement to to report or to think about reporting to the extent it's material, short, medium, and long term separately. And in fact, if you're going to make a case for climate transition in a business with high capital expenditure and long operating cycle, you cannot do that based on short-term arguments, right? It has to be a long-term story. So that is part of the thinking.
Thank you.
Okay, I think we might have exhausted the questions. They were excellent questions. Thank you. Or maybe there's one more.
It's not a question that I have, but it's a joy to see you getting all these questions here, because we in the ISSB, we received very much the same type of questions, and setting the standard for a global would say accepted standards is something that's not just a challenge by itself, but looking into the beneficiaries or the users or the stakeholders it's a challenge by itself. The thing that I would say that, and one of the main issues that was raised at the accounting forum or the accounting setter forum, that there are too many setters for the sustainability standards. And they thought if we bring all the standard setters in one room, that we would have a unification, or we would have a good forum to bring everybody on the same place. But I would want to hear your thought on that, because very much we counted the 12 responses.
Yeah, I mean there are different needs. So writing the greenhouse gas protocol is not quite the same thing as writing a climate disclosure standard, for example. We've partly got so many because they were never mandatory. And so there were lots of NGOs and other initiatives that thought, wouldn't it be good if we had a standard on this or a framework on that? And a standard, by its very nature, a standard in a particular place for a particular purpose, by its nature is a monopoly, right? That's where it's economically most efficient, right? And that's why it's a public good. So actually, there shouldn't be more than one standard for the global baseline. That doesn't mean that there shouldn't be more than one standard in the sustainability space. Right, so a standard on impact materiality would be different from a standard for the global baseline, for example, or a standard on how do you measure water consumption or something, right? You see what I mean? So I can see there still being multiple standards, but there being much greater clarity about how they fit together. And it wouldn't make sense to have more than one global baseline.
I have a question regarding, my name is Ahmer, I am from Tisney. Regarding, the scale of the disclosure, what actually will be required, to disclose. For example, if we do it at a consolidated level, that I can understand, but extending it to the joint ventures and the investing entities in different jurisdictions, different countries, will be, is quite difficult, even getting the information, it will be very difficult. Plus, it will be kind of a double counting, that some different entities are reporting something similar, reporting, the similar items,
Yeah, so on the double counting question, in principle, the greenhouse gas protocol shouldn't lead to double counting. So if you add up all the scope 1s, you get, if every entity reports, you add up all the scope 1, you end up with total emissions in principle, and all the scope 3s will cancel out. Now, for any given entity, the same emission should appear in different organizations. So, if you're a supplier to Toyota, then your emissions are part of your business. They're also part of Toyota's value chain. So they're being reported twice, but it's not double counting. It's in any more than the cost of employment in your business is reported by your business, and it's reported as part of the cost of sales of Toyota as well. But that's not double counting as such. So there is a practical challenge, which is do we actually measure in such a way that ensures there isn't double counting, rather than in principle there shouldn't be? And again, I think that's a question of the evolution of the system. We're not close to that yet. Another general comment I'd make is that I think it's really important to focus on the significance, even if we don't use that word. You know, the financially material items, because if you think that focusing on financially material sustainability related issues basically means telling investors what matters to them in making an investment in your company. So if you're not able to tell them what your financially material sustainability risks and opportunities are, that means you've got a material risk and opportunity in your business that as a management team, you don't have a number for, or you don't have a handle on. So in print, you know, if you think about it the other way around, instead of thinking there's loads of sustainability risks and opportunities that we could report on, you actually think, well, we're running the business, so what is it that we already feel that we need to know, actually? Do you see what I mean? So if you're, well, again, take the Toyota example. If you're Toyota and you're unaware of how much of your fleet is diesel and how much of your fleet is hybrid and how much is electric, then you're not doing a very good job of carbon transition, right? But you know that because it's strategically important. And that's what we want you to report. And if some minor issue down the supply chain or in a joint venture or whatever is not strategically important, then don't report it. So it shouldn't be as difficult, I think, as it seems that it is. And one thing, I think in general, if I were to sort of summarize all of this, I think I would say what's for me really important in this is the co-creation and evolution, that we're all figuring out what good sustainability reporting should look like. So there's not going to be a rule book which says you must do this and you must do that. There's going to be a set of standards which say, here's a framework within which to report financially material information. You, the board, you, the management team, need to figure out what that is. And then that framework will evolve over time. Yeah, it'll be very interesting to see what sustainability reports look like in 5 years. I don't know. Your guess is as good as mine.
Traditional financial statements, and of course I'm not an expert on something that doesn't exist yet either, so but I was just thinking, I seem that ISSB has 4 pillars, right? Targets and metrics, strategy, governance, and risk management. And I was talking with my colleague who was saying, well, the only thing you can really measure quantitatively is metrics and targets.
Yes.
And that makes it similar to the IAS, no, the International Accounting Standard.
That's right.
Now, if I look at the practice of financial markets, when you do the International Accounting Standards, then companies like to give guidance, sort of context, right? It seems to me that these ISSS are sort of sucking in the guidance into the ISS itself, because the strategy, risk management, and what was the third one? Governance, that do not give numbers, they contextualize the metrics and targets. Is that sort of...
I see what you're saying, that there's an important difference, which is that international accounting standards are by design reporting on what has happened in the past. So, you know, the definition of an asset or a liability is it's as a result of a past event. So you're only reporting profit last year, you're only reporting assets and liabilities that exist at the balance sheet date. There's no looking forward. The difference with sustainability reporting is part of the disclosure is what's your transition plan? And so what is it you're planning to do? And then the targets and metrics become more important.
Yeah, but it looks like guidance. You're sort of confirming, because it looks like guidance to what will happen out of the emissions that you're reporting in that. But
it's specific to sustainability. It's not tell us all about everything to do with your business. It's you have a climate transition plan, you have a commitment. What is it? Tell us about it. Tell us how you're going to get there, and tells what the targets and metrics and performance are along the way. Right? That's different from saying, tell us about your corporate strategy in general. Do you see what I'm saying? Which is something you can write a standard which says, describe your transition, your net zero transition plan. You can't write an objective comparable standard which says, tell us your strategy. There's a subtle difference in there. You see what I'm getting at?
I see, but I see that. That's a clear distinction, but it does not entirely exclude what I said.
Okay,
You're still providing guidance and context to the metrics and targets related
Yes, that's
to
right.
your
You are,
sustainability
absolutely,
strategy.
absolutely, yes.
And you do that within the statements
Yes.
rather than outside, like typically would happen.
Oh, well, it depends what you mean by inside the statements. Yeah,
Well, when you well, we'll see how it will go, of course. But when you write, statements under, say, the strategy pillar, you are sort of commenting and explaining the numbers that you have reported in your metrics and targets and how they will evolve in the future, right?
But in the financial reporting, there's two things you're doing, right? You're producing the accounts, and you're producing a strategy report, or whatever you call it, the front half, right?
Yeah.
So there's very little guidance on the front half, and all the rules are about the back half, and they're all about the past. And so the narrative disclosures that are in that section of the report are all about explaining the numbers about things that happened in the past. Right. So in a sense, you can think about this as putting more structure to part of the front half. Right? So it's putting more structure on, if you're an investor, you want to be reassured that the company is thinking about, has a risk management approach to, has some scenario analysis and planning and transition and so on, insofar as it's going to have to make a sustainability transition. And then it has metrics and so on that back that up, and it has management compensation that's aligned with that and so on and so forth. So it's putting more structure on the front half, that is right.
Thank you.
Assalamu alaikum. My question is, or first, here's Abdullah Schneber from EY. I thank you for this great session. And my question is kind of an extension of the discussion we just had. A principle under IFRS is that report if you are able to do so. Mm-hmm. And if we look at the existing voluntarily disclosures by global companies on ESG, maybe it's voluntarily, maybe you agree with me that the largest obstacle or struggle that is being faced by these companies is quantifying the impact. How do we see that the IFRS sustainability standards addressing this issue?
Yeah, okay, so notice there's two very different ways of thinking about quantifying impact. One is quantifying impact on society, which we're not asking for. The other is quantifying impact on your financial statements. And the answer to that is, if amounts have already been recognized in the financial statements, then there might or might not be disclosures already required that you've got a big impairment loss, explain why you've got a big impairment loss, or you've got a provision, explain why you've got a provision. And there may be sustainability related explanations. So the real issue is quantifying future financial effects. And on that, I think frankly that there's some wording in the standard that needs tidying. That's also part of the feedback, is that wording needs tidying. And notice there are, again, two quite different meanings, right? One is you have a transition plan. The transition plan will require a certain amount of capital expenditure, a certain amount of operating expenditure, and a certain amount of financing. Tell us about that, right? The other interpretation is the revenues and expenses of your business are exposed to climate-related factors. Tell us what your future profit will be, right? Now, we're not doing that, right? But it's easy to interpret, explain financial effects as that. That would be unrealistic, I think, in a variety of ways. But I think it's not unrealistic to give some guidance on the financial effects of whatever it happens to be, the transition, the capex and the opex. But that's by the way, that's my view. So we've got the feedback that the wording is not great. Where we're going to end up on that, I'm not sure. But it is an inherently quite a vague topic. Again, it's one of those things where market practice will evolve and itself start to determine what practice ought to be, actually. All right, thank you. Wonderful questions. Thank you very much.
Thank you, Dr. Richard, and thank for everybody who has given us great opportunity and to discuss these important topics. This is the start. Hopefully, when this drafted being decided to be an official standard, we will have more discussion about it, how we can implement it. Maybe there will be training programs, implementation guidelines, and things that it will goes in that direction. I did think this will be an easy task, but SOCBA with its stakeholders will do a better job working together to make sure that these standards can be implemented in Saudi Arabia the right way from the right people. Thank you very much for your presentation.